lifesaver.
This of the series of the academic year. I'm Joyce Kennedy. I'm the Director of Community Relations, and welcome again. This morning we have Jim Hoch here from Tailwind Capital, and Kathleen Suss will introduce him this morning. So without further ado, I'd like to introduce Kathleen Suss, who's the Executive Director of the Concordia Conservatory, who will introduce today's speaker. Thank you, Kathleen.
So there are individuals who have spoken at Concordia College's Business Breakfast Series, and these are the top community members who are at the top of their field, sharing their story with our campus community, just like today. And yes, today, our speaker, who is at the top of his field and the top of the community. It is my pleasure this morning to welcome to our campus the 2014 President's Award of Excellence in Education Service to the Community honoree, Jim Hoch. Jim graduated from Williams College and earned an MBA from Harvard Business School. He is the founding partner of Tailwind Capital, as we all heard earlier, a private equity firm, and currently heads their business service practice. Actively involved in the private equity business for more than 25 years, Jim has served on more than 20 public and private boards and participated in over $1.5 billion of private equity investments. Prior to forming Tailwind, Jim worked for nearly 2 decades at Morgan Stanley and its private equity affiliate, Morgan Stanley Capital Partners, where he was managing director. Jim and his family relocated to Europe and London for 6 years, where he led Morgan Stanley's Capital Partners Europe. A close neighbor of Concordia College on Tanglewood, Jim and Mary's 3 children, Bill, Julia, and Ross, attended Concordia Conservatory for many years, and as founders of the Hoch Chamber Music Series in 2001 here at Concordia. Jim and Mary's generosity and vision brought world-class music to the Summer Center for the benefit of all of our community. We are fortunate to have this community member, philanthropist, investment expert, and devoted family man with us today. Please help me in welcoming Jim Hoch.
Thank you, Kathleen. Hopefully everybody can hear me. If you can't, you can wave or something like that during the presentation. That was a very nice introduction, and almost all true, not necessarily all parts of it. But I'm not sure about investment expert. I'm not sure about some of the other things Kathleen said. But thank you for inviting me to come and speak this morning. Hopefully this will be somewhat informative. And I understand some of you may have a class assignment based on this, and so the only problem is I can't guarantee you that any of the information that I have is actually accurate. And none of you should plan to buy securities based on these discussions. We'll get to the important disclosures page that says everything I say you can't actually rely upon for these purposes. So, as Kathleen said, I've been in the private equity business a long time. I actually, when I graduated from college, I went and worked for Morgan Stanley. Spent 2 years there in 1982 to 1984, so before at least some of you in the room were born. And in that time, started working on private equity deals, which at that point at Morgan Stanley Morgan Stanley at that time was a private partnership. And we were trying to put together a transaction that was going to take a total of, I think, $2 million from Morgan Stanley. This was in 1983, and we had to go to the senior partners committee and get them to agree to give us $2 million to do it. We made the investment in the company. I went off to business school, and I think it promptly went bankrupt within about 6 months. And we learned a couple of things. One, we needed to be a little better at some of the parts of analyzing the companies before we made the investment in them. And secondly, we needed to find another source of money. And so we went, by the time I returned from business school, Morgan Stanley had raised its first private equity fund with third-party investors. And if you were to think of a timeline, so that was 1983, one of the first classic leveraged buyout transactions took place in 1982 when some people bought Gibson greeting cards. and had a very successful transaction. And that was probably a $100 million deal. And in probably 5 years later, there were people doing billion-dollar private equity transactions. And by 1988, so really only 6 years past the first deal that people really thought about, you had KKR purchasing RJR Nabisco, which was about a $25 billion transaction. By 1989, you had some people trying to take United Airlines private, and that deal actually failed. And at that point, a lot of people thought the business had ended in private equity because they thought you could no longer do transactions like that. So in a relatively short span of time, it went from very small transactions to extremely large transactions to people thought no more transactions. Now that hasn't happened. The business has continued. And why don't I spend a few minutes going through the transactions, or going through the business. There we go, okay. So here are the disclosures. Please read all of these and memorize them. And if this is being recorded, hopefully you'll record the disclosures very carefully. So what is private equity? The term private equity, I'm not actually sure when it started. There are really a lot of different private investments that people do over time. And so if you've looked at it, originally what people thought about as private investments was more what people think about today as venture capital. And there were groups that got together and made investments in private companies, but more startup companies. Eventually, a number of people, some of them who later went on to found KKR, decided that they wanted to do more mundane businesses, general industrial businesses, not necessarily the next Apple or Microsoft, but simply a business that made widgets, that made automotive parts, that made something else. And they found what you could do is you could do a transaction where you could borrow a lot of money, put in a little bit of equity, and hopefully then make a good return on your equity investment as you paid down the debt. That was sort of the original private equity, was leveraged buyouts. That over time has continued to morph. You'll see some people will classify some real estate transactions in private equity. There are some people that'll do distressed debt that sometimes gets classified there. The business that Tailwind is in is much more around what we would call growth equity, where we're making investments in companies that we hope are going to grow at sort of low double-digit rates. So not trying to create the next Facebook, but trying to get a business that can grow at 10, 11, 15% or something like that over a number of years. So it's changed over time, but the way I think about it is it's really essentially what I call managed private investments. So just like you probably know, very familiar with Fidelity and Vanguard and other mutual funds that manage people's stock portfolios for them, where you hire a professional manager who's going to manage it by buying into a mutual fund. Essentially what private equity managers are doing is they're doing the same thing for investors, except they're buying private companies. This is just a quick snapshot of alternative investments. And again, sort of private equity is a subsegment of alternative investments. And here, I just got a quick breakdown of sort of what it looked like in 2011 and 2016. And actually, the numbers look a little different, but there's a couple of these categories that are actually combined in the 2016 numbers. So, in fact, the private equity business is around 30% of what people think of as an alternative assets. Though you can see that number's not quite doubled between 2011 and 2016. So 4.8 trillion to 8 trillion. So it's a reasonably large part of the investment universe, and there are hundreds of firms that are part of that business. Sort of one of the questions is, why do people bother to invest in private equity? If you look at these charts over time, that's the S&P 500 since 1986, so for the last 30 years. And it's generally gone up over that time period. But I think that generally upline is somewhere around 7, 8, 9%. over that time period, is what people have returned. The other chart is the 10-year U.S. Treasury. So what's happened to interest rates over that time period? And if you took this back to when I started working, that number, instead of being 10%, was closer to 15% is what the Treasury bonds were. So at one point, you could buy a Treasury bond and earn 15%, which was pretty attractive. What's happened over time for the large investors that are trying to put money to work is they've found that you can't do a safe 15%, you're now getting a safe 1.7% or something like that. And the equity markets, the stock market has done a good job for investors, but many of the people who are looking to us to manage their money are trying to find ways to get returns that are higher than what they can get in the stock market. And so then they start looking for other alternatives. So again, sort of all these charts of real estate, hedge funds, commodities, infrastructure funds, all of those are ways that generally large institutional investors, not necessarily individuals, are trying to find ways to get returns that are above what they can earn in the markets. And this is basically since 2000. If you look at the returns, you can see what some of those different alternative asset classes have returned and compare it to the S&P, that red line there. And so private equity has done reasonably well over that time period, and therefore has been able to give people returns that are better than what they could get in some of the other asset classes, and therefore help these large institutions earn more on their investments. So who are the players in this, and who are the people that are essentially giving us money to invest in these private companies? So if you looked over here, the people that are the investors tend to be large pension funds, public and private. So it used to be, when the business started, that the largest investors in private equity would be people like the AT&T pension fund or the General Motors pension fund. They were certainly two of the largest that we had as investors at Morgan Stanley, and two of the largest across the board. Those corporate pension funds actually largely don't exist anymore if you looked out there. Most corporations have moved to other types of benefit plans. The people that are now the largest investors there are the public pension funds. And many of you, or most of you, probably won't go end up working for a government that has a public pension plan, but most of you will be taxpayers. So how those public pension plans perform will make a big difference to you, because if it turns out if the New York State public pension plan doesn't do well, they just raise your taxes to pay more money into the pension plan. So hopefully the pension plans are invested well. If they're invested well, then you end up with a lower tax rate for those things. But those are the biggest investors. So CalPERS, which is California, one of California's pension funds, is I think about a $300 billion pension fund, and they probably have $30 billion in private equity. The other big players of people that are trying to put money to work, the sovereign wealth funds. So a lot of foreign countries have large, in some cases they're their own pension fund, and sometimes it's the fund of the government. So many of the Middle Eastern countries have very large pension funds that are very large funds that they invest into private equity. So our business as a PE firm is to actually go out and convince those people to give us money so that we can then go invest it into private companies. If you think of sort of who are some of the PE firms, there are, as I said, there are hundreds of PE firms out there. Some of the largest you probably will have heard of: KKR, Blackstone, Carlyle, TPG, Apollo, Warburg Pincus. And then there are tons of small firms like Tailwind. And the large firms have funds that they manage that are sort of $10 billion and up. So very large pools of money. They tend to invest in fairly large companies. And then the smaller firms are having funds that are, say, $500 million to $1.5 billion. And so generally, we're investing in companies that might be $100 million to $300 million in size. So again, not RJR Nabisco, but some very interesting companies that we're able to find. This is a little bit sort of then and now. When the private equity business got started, if you looked at it, people put in relatively large amounts of debt compared with the amount of equity that they put in. So I just made sort of a real simple chart here and said if you looked at what a deal looked like in 1986, somebody might have put in $20 million in equity, $20 million in mezzanine, which is sort of higher risk debt, and $70 million in senior debt. And what you hoped to do over the next 5 years was hopefully you'd pay down some of the debt. So the senior debt would go down. They probably didn't pay down any of the mezzanine debt. And if the business, and in my example, you've got something that's growing from sort of 110 to 150, that's actually the company value going up by about 7% a year. But since you bought it with a lot of debt and a little equity, assuming you pay down the debt, your equity goes up by a lot more than that 7%. So that example over 5 years, you've got the equity going up by about 5 times, and that's close to a 40% per year rate of return. So again, the whole asset doesn't have to grow that fast. If you're able to pay down the debt, you'll get a lot of that return into the equity. Because the debt holders only get a fixed amount of return, so everything else falls to the equity. In 1986, some of the things we were doing at Morgan Stanley, instead of having, sort of 20% equity, we were able to do deals with between 5 and 10% equity. And so you're able to have assets not grow that much, and you're able to make a fair amount of money on the equity return. Today, if you looked at the business, it's actually quite a bit different. What you'll find is that same company, so in my mythical example, you've got a company that's earning about $20 million in earnings. Instead of buying it for 5.5 times, people are paying 10 to 11 times that 20 million. And so what's happening is you actually can borrow about the same amount of debt as you could before, and you now have to put in a lot more equity into the transaction. So in that same thing, if the business grows at the same rate, my 130 grows to 210, and I'll end up with 1.6 times what I started, and that's more like a 10% rate of return over those 5 years. So still not a terrible return, particularly if you think back to those 2% government bond yields, but a lot different than 40% rate of return per year. And so that's caused people in the private equity business to say, okay, one of the things we need to do is maybe refine our strategy a little bit more, maybe change our strategy a little bit more, because our investors would really like to have us earn more than that 10%, because again, they're trying to average up. Again, your CalPERS, you've got $300 billion portfolio, and you're trying to average up the other $270 billion by making a little bit more on that $30 billion. So they're looking for ways that will do better than that, and what people found is you can't quite do the same thing that you used to do. If you look at it over a shorter period of time, sort of since maybe 2006, say sort of the last 10 years, what's happened in the business, which is the last 10 years, you're probably all a little more familiar with. We had a recession in 2008, so things got a lot worse for everybody. And then they started to get better. There was a period of time where, going back to my example where I was borrowing $70 million, nobody wanted to lend you money in 2009, so that was hard to do. And in the last couple of years, it's gotten a lot easier to borrow money. What's ended up happening from all that is that all of a sudden pricing's getting more expensive. and there's a lot more people in the private equity business competing with you. So the question is, if you're in the private equity business, how do you compete both for capital, so both for raising money from investors, and also how do you compete for investments? And that's what I was saying, was that's why what you'll see if you looked at the private equity industry is there's more stratification and more focus where people are narrowing what they're trying to do, because it's easier to both sell to investors and sell to companies that you might try to buy if you can say, I don't do everything, I just do what you do. So there's a couple more charts, and I'll go through these sort of quickly, but this is just sort of how big is it and what happened over time. As you can see, a lot of money was raised, 6, 7, 8. All of a sudden, people thought the world had ended, and so they stopped giving money. But there's still lots of funds out there, and people are still raising lots of money. If you looked at the transactions, again, 2006, 2007, very busy times in the private equity industry and relatively larger transactions. I think the average transaction in 2007 is something, on this chart, is something like $300 million, which means there are a lot of small ones and a few really big ones. If you looked in 2009, that was probably an average of a little under $100 million. Which I think what really happened is there just were no large transactions taking place. So that brings the averages down. This is what's happened over time as to what people are paying for transactions. So again, what you saw was sort of consistently high, falling off, but then coming back. And in the last couple of years, it's actually probably, people have actually been paying even more for transactions than they did in 06, 07, which worries a lot of people because they worry about that you may have another bubble era where you're going to have a lot of valuations go down in the future. But part of that is, again, go back to that chart on interest rates. Interest rates have been consistently going down, and what investors are trying to do is, beat what that sort of government bond yield is. This shows you how much money you can borrow. So again, when we talk about leverage, that's going back to my chart. The $70 million in senior debt and $20 million in mezzanine debt, that's the leverage. And the multiples here are really against the operating earnings of the company. So people were borrowing 5.5, and then it fell off. And then in the last couple of years, you'll notice that those same 2 years that have the very high purchase price multiples are also the ones when people borrowed a lot of money. And that, again, some people worry about that as to were people borrowing too much money again, and is that going to cause trouble going forward? The good news is, for the private equity business, we've still been able to sell businesses. So this is sort of how much of the companies have we been able to sell over time. Because the thing about the private equity business is we make investments in companies, and then eventually we're going to sell them on to somebody else. And that's how we get our return for our investors. So again, a little bit like a standard portfolio manager, you're going to buy some stocks, you're going to sell some stocks. The difference is there's not an easy market to sell them on, but you're able to sell these companies on to somebody else and then give the money back to the investors. So again, if I think about from a private equity investor standpoint, the big problem that we all have is if we can't simply have a business that's going to grow at 7% over 5 years if we're going to actually have anything close to the returns we're trying to convince investors we can give them. So I'll talk a little bit about Tailwind and how we approach it. First, just a quick summary of Tailwind. Tailwind's been in business for about 13 years, I guess getting almost 14 now. It was actually founded by 3 of us who had worked together at Morgan Stanley for a long period of time. Actually, some of you in the community will know Frank Sika, who's another partner at Tailwind. and then the other senior partner is Larry Sorrell, who for many years lived up in Scarsdale. So relatively small group of people, 24 full-time professionals and 16 operating executives. So we actually work with people who've run businesses for their career. We'll actually have them work with us to help both identify some investments, but also often become the sort of senior executive chairman to come in and help the management team decide how they can do a better job in the business. Because as investors, we actually don't go in and try to actually work at the company, but we are much more set up like being a board of directors, and we'll spend time with a portfolio company, once a month, once a quarter, sometimes more frequently, but a number of times a year, helping them think through their strategy, helping them think through what they're going to invest in, but not trying to tell them if what they're doing is they're doing environmental consulting. I'm not going to go in and do environmental consulting and tell them how to do that. Investment strategy, growth-oriented. We tend to have a strategy which is to try to find companies that can often make small acquisitions to help grow their business. So if you looked at a typical company we might invest in, it might be located in the mid-Atlantic states, but what they do is something that people need all throughout the US. And so we'll help them buy other companies that do the same sort of thing across the US so they can end up with a national reach. And then, so since we started, we've invested in 33 portfolio companies and done 52 of what we call the add-on acquisitions. So again, smaller businesses that we'll buy that will help them grow the company. And our current fund is $1 billion fund. So we have 3 focus sectors that we look at. One, healthcare. Second is business services. A third is industrial services. Those are fairly broad categories, but generally we try to find companies, as I said, that we think have the possibility to grow at sort of 10 to 15% top line. Hopefully, if we do a good job, their operating profit will grow faster than that. And in some cases, we're able to do that, as I said, through doing acquisitions. If you looked at the one company I was talking about briefly there was Apex, which is an environmental services company. And that was one that when we bought it, it was about $60 million in revenue and was really focused on doing things like stormwater, wastewater. They are not doing the Bronxville stormwater reclamation or renovation project. I actually think they did take a look at it and they concluded that Bronxville was thinking they were going to get it done for less than it was really going to cost, which has turned out to be true. But they will do they've done projects for larger municipalities. They do work for Walmart. Turns out businesses like Walmart have to worry about, you build a big building, you have a lot of concrete, it rains a lot, somebody has to figure out how to deal with the water that's coming off those buildings so it doesn't overwhelm a city sewer system. And so they'll go in and help consult to Walmart across the country on how to fix those problems everywhere. But they're one that we grew. We've probably made 10 acquisitions with that company since we made the investment in that in 2010. And so that would be a pretty typical strategy for us. And so today Apex is getting close to $200 million in revenue. So it's gone from 60 to close to 200 million by doing all these add-on acquisitions. We execute sort of similar strategies in the other areas. I'd say the other common thread with what we do is it's a lot of services businesses, which for us means it's a lot of companies that don't take much capital investment. So we like them because you get a fair amount of cash flow out of the business. So back to my chart there, that's how you pay down the debt from 70 to 30. is you get enough cash flow out of the business that you can pay down the debt, and you're not having to reinvest in large buildings, large equipment. They're pretty capital efficient businesses. These are just some overall statistics. So again, if you say, how do we try to grow the businesses? It's a fair amount, about 60% of it would be the growth in the original company, and about 40% would be from the businesses that we buy to add on. The other advantage of the add-ons, that chart I showed you that had the multiples, that's what people are paying for what I would call the original platform. And so that's gone from, again, 1986, it was 5 times. Now it's 10 times more often than not. If you looked at the smaller add-ons that we do, those are still being sold around 5 times. So we're able to buy smaller pieces at a much lower price. And so a business like Apex, if you paid, in that case we paid about 8 times up front. Most of the businesses we've added to it are around 5 times. And so over time you sort of lower your average cost by doing that. So in conclusion, and then I'd be happy to take questions if you have questions. It's been a pretty good asset class for investors over the last 20 years. When we go talk to our large investors, and the CalPERS, the Oregon State Pension Fund, people like Thrivent Insurance, which is actually the Lutherans insurance company and investment company. You go out and talk to them. They have a pretty good view over a lot of different asset classes. Most of them will tell you that their private equity portfolio is their best performing asset class over the last 10 years, even after all the costs and the fees and all the things that you read about in the paper. And most of them just have the question of, we'd like to do more of it. How can we do more of it? But it's been a good performing asset class for the investors. For people like Tailwind, our conclusion was we were going to do a better job of delivering those returns with growth-oriented businesses. And so I think you'll find many of the smaller private equity companies have gravitated towards that type of growth strategy. And ideally, we are helping these companies grow faster than they could on their own. A classic business we'll buy will be run by an entrepreneur who's built it from $0 to $100 million. We're able to help them with some of our experience and knowledge. I mean, as Kathleen said, I've sat on a lot of boards. Part of that is you get to see a number of things people do well over 30 years, and you get to see a number of things people do poorly over those 30 years. And so sometimes we can help a 40-year-old entrepreneur figure out how to not make some of those mistakes and do some things better and grow a little faster. And so that's been our strategy. And as I said, part of what's driven the interest in, I think, private equity for investors is if they're looking at a 2% government bond yield and a stock market that they think is high, they're trying to figure out whether or not they can find some other place to put their money to work that you can get decent growth out of. So that's my quick summary of private equity, at least the way we at Tailwind approach it. There's some other people in the room who probably are also pretty knowledgeable, so if I can't answer a question, I may ask them to answer the question. Some of the audience over there. But I would be happy to take questions for you. Thank you for all coming out so early in the morning. I hope the breakfast was good.
Your exit strategy, where are most of your exits going? Are they going to other private equity, public, other companies? What is your segment?
Yeah. So when I was at Morgan Stanley and we actually bought somewhat larger businesses, we would take some of the companies public. Taking a company public, I mean, in our mind, you needed to have a company that was worth really $500 million or more to make it worth taking public. Otherwise, it's actually a fairly difficult thing to do. The way all the regulations and the things that the SEC's added over time, that makes it unattractive for smaller businesses. So at Tailwind, we've never taken a business public. When we look over time at who do we sell it to, it turns out for us it's about 70% strategics, so other companies are buying it, and about 30% go to larger private equity firms. I think when we started a little over 10 years ago, we would have told you we would expect that to be at least 50-50. We would have thought there'd be more private equity firms that have been buying from us, but we've been able to find businesses where we can get a strategic to pay more for it, because we've either done a good job of building what they want to buy, or have just happened to get lucky a couple times.
Thank you, Jim. My name is Dr. Powers. I want to start off by thanking you and your wife, Mary, for your generosity to the community at Concordia College. I guess back in the 50s, under the Eisenhower administration, ancient history, the comment was, what's good for General Motors is good for America. And so what's interesting to me is the idea is, how does the equity investment monitor what's going on in our society and the prediction of what could go on in our society? More specifically, and I'm speaking here as an individual because I'm a board member and I'm a delegate to the State Medical Society. There's a company in New York State called Medical Liability Mutual Insurance Company. What I'm presenting is public. And public knowledge, that this company was approached by Berkshire Hathaway, Warren Buffett, and he wants to buy the company. And he's so far collected about 6 malpractice companies around the United States. And not a large amount of money here. We're talking about $5 billion, $3 billion in reserve and $2 billion in surplus. And the idea is that he's going to buy this and then continue to, issue policies to the 14,000 private physicians in New York State. So my question is, does Warren Buffett see something that I can't see? Does he see a trend that's going on in terms of medicine here? And is he hedging or betting for what's going on in Washington, D.C. in terms of a single payer? Thank you.
So I have absolutely no idea, but I'll make 2 observations. First of all, Warren Buffett over a long period of time has been one of the smartest investors, I think, ever. And so he usually does see something that others don't see. Part of what he may see, though, Warren Buffett's, while he owns lots of different things, what he really likes owning is something like an insurance company. And I mean, Berkshire Hathaway is an insurance company, even though it at one point sold shirts and it sells lots of other things. And so what he really likes to do is collect premiums and then go invest in something else. And he must have concluded that, so if you look at the things he buys, he has reinsurance companies, he has life insurance companies, he has property and casualty insurance companies. So he likes things where he can collect the premium. Hopefully the lawsuits won't come for a long enough period of time that he can have invested in the Burlington Northern Railroad or IBM or Coca-Cola and make enough money on that it will offset whatever insurance liability that's out there. He also historically has looked for what he thinks of as uncorrelated risks. So he likes catastrophic insurance because a hurricane coming is probably going to be totally uncorrelated to what happens in the economy. And he may figure the same thing with malpractice insurance, that it's going to happen, but it's not going to happen at the same time that his energy company gets in trouble or does poorly. So that's my guess as to why he likes it. He also has, essentially, he's in a better position to take all of these risks than almost anyone else, given how valuable his company is. So, how about any students that have questions? No? Are you a student?
No. Actually,
have a question on behalf of the students.
Okay, all right.
There are a number of business students in the audience. Some of them are seniors.
Yep.
That are about to embark on their career in business.
Right.
So what advice would you give them?
So again, I'm not sure I have very sage advice since I've really had 2 jobs since I got out of school, and one of them was with the same group of people that I was working with at the first job. So there are other people who've been much more successful at finding and moving between jobs over time. I always joke that I went back to Morgan Stanley out of business school because I couldn't get a job anywhere else. But I mean, part of what I would suggest people should think about, first of all, you should figure out what you're good at and what you like to do. That's useful because if it turns out you don't enjoy your job, you will make yourself miserable for a very long period of time. I think you do want to figure out where can you get a job, particularly early on, where you can learn a lot. I have watched over time some of the younger people who've worked for us who are in such a hurry to get somewhere that they don't necessarily take a job that helps train them. So there's one of the fellows who's an operating executive who works with us that I've known for about 15, 20 years now, I guess close to 20 years. And we brought him in as an executive to run one of our companies at a relatively young age. It was a bit more of a technology business, so it made sense to have him do that. That business, we ended up selling. He sort of said, what should I do next? And I told him my advice was he'd worked at some smaller startup companies. He should think about going and working at a larger company where he could get mentored and trained, because there were a number of things that I thought could help him. He's successfully gone off and worked at a couple of bigger companies. He ended up becoming the CEO of, had a very senior job at Avaya, and then became CEO of an international security company that he worked with. And after he left there, we actually have gotten him to work with us, and he's now he really oversees 2 portfolio companies that we have. And I can see a big difference in him now than a number of years ago, because he actually went somewhere where he was able to get trained by some pretty good people and then move on from there. So I would say in your first couple of jobs, it's worth looking for those jobs where you can get good training and good mentoring to help you work through your career. Because you really have more time to do this than you think you do. That would be one suggestion. Yeah.
So 2 questions. One is, how do you find your investments? You were commenting that it's more competitive now. So what's the process for finding investments? And then secondly, what happens to the investments that are not, they don't meet your expectations? The unsuccessful.
The unsuccessful ones. So the first question, how do we find investments? It's a combination of things. Part of it is, again, the partners at Tailwind, most of them have been in this business for anywhere between 15 and 30 years. And generally, we focused on, the areas we're investing in are the areas that we have been investing in for a long time. So you get to know different industries, you get to know people in the industries, you get to know investment bankers in those industries, you get to know accountants in those industries, consultants in those industries. And so over time, you'll get to know enough people that you will end up either getting introduced to companies, or when somebody, generally we're buying stuff somebody wants to sell. So an owner has decided, I've owned this company, I'm a corporation and I want to sell it, I'm an individual and I'm getting closer to retirement, or I need more capital for something. So they will go hire another advisor who will go out and talk to people like us to find out, how can they sell their company, how can they monetize their company. So part of it is us being out and marketing and talking to enough people and being clear enough in what we'll invest in that people will think of us when they think they want to sell the company. So that's a lot of it. We do a lot of effectively outbound marketing to people that might have a company that would be for sale. But again, in 1986, there were a handful of private equity companies that would do stuff like this. It was fairly easy. There was competition, but not that much competition. Now there's a lot, so you have to be much more focused, and you have to be much more able to describe to somebody what it is you want to buy for them to be willing to sell it to you. The second half of what happens on deals that don't work out, again, it depends. So there are some businesses that we've invested in that underperformed our expectations, but we still made some money on it. We still will work with the companies. We'll still figure out what we can do with them. We'll eventually try to sell it on to somebody else because, the way our money is set up, it's actually an investment pool that has a limited life. So we have a 10 to 12 year life of an investment pool. So we'll get the money from our investors, we'll invest it, and we'll give it back to them within that time period. There are some investments that don't work out in the sense of that 70 million of senior debt and 20 million of mezzanine debt. The company ends up really underperforming. Those people end up owning the company because they'll essentially say, you haven't paid us back the money you owed us. We get to get the company and then we get to sell it. And that's happened sometimes. But generally, companies that underperform, you're going to do the same things with them as the ones that perform well. In fact, one of the dangers of the private equity business is the ones that become problems, you end up spending a lot more time on to try to fix them, to get your money back, than you probably should. But it's sort of human nature that if something's not working, you spend a lot of time to try to fix it. And the ones that are working, you say, great, they're working, I'm not going to worry about those. All right? Yep.
What is the fee structure that you have for Tailwind to keep the lights on and the electricity flowing?
So we have agreements with our investors on, they'll pay us a fee on the assets under management. So we'll go out to investors and we'll raise, we've raised $1 billion fund that we're investing. And during the investment period, they end up paying us, it depends on who the investor is and how big they are and how much money they gave us, but somewhere between 1% and 2% of the assets that we're managing for them. And then we get a percentage of the profits. So, and that can run anywhere from sort of 15 to 20%. And if you looked at the private equity and venture capital industry broadly, I think you would see the fees run between 1% and 3% on assets under management, and what they refer to as the carry percentage or the profit sharing percentage runs 10 to 30% is probably the high end of what people get. But the returns that the investors look at, so when I say that Oregon tells us that it's the best performing asset class they have, their returns are after all those fees when they're looking at it. So that's how we keep the lights on. That's how we charge the investors. Yep, in the back.
What determines whether a investment is worthwhile? In a sense, where do you use indicators such as return on equity or return on invested capital to see whether your investment is worthwhile? In a sense that there are several variables that could affect you being not successful or lead to failure.
So, we'll look at, again, part of our investment strategy is to invest in businesses that are ongoing existing businesses so we can go look at the historical performance of the business. So before we make the investment, we'll look at a company and say, right, what is their return on equity or what is their return on invested capital? What's their, what do their margins look like? We'll usually try to compare them to other people in the same industry that we're familiar with, because we're generally trying to look at a business that we think either performs well or we think there are obvious things we can do to help it perform better. And so some of what our analysis is going to be is they're currently earning this much money against the price we're going to have to pay. And we're going to try to decide, how do we think they can earn more, right? Are there easy things we can do? Are there ways we can help them so they'll be able to earn more money and therefore be able to grow faster? Sometimes our conclusion is, we bought a business in 2008 and it had about a 10% operating profit margin. And our conclusion was the best thing to do was to drive that operating profit margin down to about 6% for 2 or 3 years to grow faster. So they had to hire more salesmen, they had to spend more on marketing, they had to make some investments in, they were a consulting firm, they had to make some investments in how they could do, they did IT implementations and they needed to have more systems and processes so they could do more types of IT systems. So in that case, we actually said, you should make less money for 3 years because we think you'll make more money in 5 years. And that business went from 50 million in revenue and 6 million in operating profit to 160 and about 20 million in operating profit. So it worked, right? Doesn't always work, but that's the thing we look
I
at.
think we have time for one more question, please. Let's do it.
No, go ahead. That's all right.
Apart from the indicators that he mentioned, what kind of technical analysis do you do on the sectors that you invest, and how frequently do you perform these technical analysis?
So we don't necessarily, I wouldn't say we do technical analysis on the sectors, right? I mean, the 3 sectors that we invest in, we've concluded have pretty good long-term trends. And so then we're looking at businesses inside those sectors. The businesses, we will go in, our typical process if we're going to make an investment in a company is we'll analyze the financials, we'll go meet with the management, we'll hire an outside accounting firm to go look at their financials in a lot more detail. Many of these companies don't have audited financials. And so it's not like looking at public companies where you can look at stuff where KPMG or Pricewaterhouse or somebody like that has gone through and said, yes, the numbers are right. We'll hire sometimes outside consultants, usually sort of think of it as sort of marketing strategy consultants, to go in and figure out what their market position is, how big the market they're in. Everybody you talk to has a huge market opportunity and it's growing very fast. The question is, how big is the market for what they do and how fast is that really growing? And so we'll hire people to spend a couple weeks analyzing that. Sometimes they'll go out and do customer calls. Why do you use, why did you use Optimal? What did you like about them? What do you think about them? So we'll do that type of analysis, though, much more around the specific business and some on the industry. Because generally we think we're picking individuals and businesses within industries that we think we already like.
How frequent is this? You invest once, then how do you analyze the growth
of that company?
Yeah.
So we'll tend to do a lot of that work up front, and then in some cases those I went over pretty quickly, but we have 16 operating executives for people who've been in these industries, who've run companies in these industries. They'll go sit on the board, we'll sit on the board. So we're meeting with a company somewhere between once a month and once a quarter to go through what are they doing, what's their strategy, what's the performance. We certainly look at the performance every month on their financials. And every quarter we'll usually sit down and have a fairly detailed discussion on strategy and marketing, things like that. And so it's in part the Tailwind team and in part these operating executives that we hire that go spend time with the companies. Is that an answer? Did you ever?
I was just going to say, what was your toughest deal? And the reason I was asking that is for the students, like, what did you do about it? Because, if it was protracted and you thought you were all buttoned up going in and you were throwing a curveball, what was the hardest deal you worked through and how?
I mean, they're different. There are different things that have been hard at different points in time. So we made some investments in the late 90s that were in the telecom sector, and we made a few that were tremendously successful. You then generally make the mistake of thinking you know what you're doing, and you make a few more in the same sector, and a couple of those were disasters. And in some of those cases, there wasn't a lot to do to fix it, was the problem, because there were a couple cases where the industry structure changed enough that you simply couldn't make any money in that part of the business. There are other cases where we've had what I would consider sort of a long slog to make something work, but it has worked out. And generally, what that turns out to be is you end up putting more investment in the company. You might have put on too much debt, so you end up taking down the debt sum. In a couple cases, we've sold divisions or parts of the company to create some liquidity, and been able to ride out a tough economic environment. So sometimes you can sort of ride out the economic environment by using more capital or something like that to do it. Sometimes you just made a mistake, and you're going to end up just liquidating the investment. And then the sooner you can do it, the better, because you just end up wasting a lot of time. All right? So thank you all.